I certainly believe that you should hold lots of cash, lots of liquidity, despite the fact that those cash savings are depriving you of purchasing power. I mean, I get perfectly well that if you're holding 10% of your portfolio in cash, that you are losing 5% of the purchasing power compounded on that 10% per annum. I regard that negative savings as an option payment.
Right.
Having liquidity, if you go into a market period that's illiquid, is priceless. I remember very well 2009, the first liquidity crisis that I was both liquid and confident. And that was a fantastic year for me. Having cash in a liquidity crisis gives you the tools and perhaps the courage to take advantage of the circumstance as opposed to being taken advantage of by it. So, and I, by the way, personally regard my bullion as cash,
Absolutely.
good cash and volatile cash. But when I look at my liquidity, I consider gold to be part of my liquidity because I can sell it in a nanosecond. Um, I don't discount the fact that if we have an economic recession, an economic reckoning, if you will, that it could be a recessionary or depressionary type investing type circumstance. And in that case, at least initially, the gold price would go down too.
Mm.
But if you look back at past recessionary periods, in particular the Great Depression, 1928 to 1936, gold held its value extremely well, precisely because people were concerned about the purchasing power of their savings in fiat instruments.
Yeah.
It doesn't matter as much recession or depression. What matters is a lack of trust in the system. When folks like us, let's just be candid, Caucasian people, fairly well-to-do, think about alternative energy, we think about things like Teslas.
Yeah.
And it's true that our future involves more gadgets and more electricity. But what's going to drive the electricity market is a wonderful, wonderful, wonderful thing. You need to tell your kids this. What's going to drive demand for battery metals is the ascent of humankind. We talked about this at the conference. 1.2 billion people on Earth don't have electricity.
Mm-hmm.
Don't think that these people are willing Luddites. They all want to live like you do. And in the last 30 years, more and more of them have. 2 billion people on Earth only have access to intermittent or unaffordable electricity. The electrification of humankind, the urbanization of Malawi, the urbanization of Indonesia, the urbanization of Bolivia, over the next 30 years will do the same thing that the urbanization of China did. And it isn't just going to be copper wires to houses. It's going to be light bulbs. It's going to be all the little goodies. I mean, can you imagine if you live in Congo on the equator, how much your life would be improved by having an air conditioner?
Yeah.
As an example. So when we talk about the effect of alternative energy schemes, battery schemes, all these gadgets, while it's tempting because we're all ethnocentric to think that we are the market, we aren't the market. We're only part of the market. The real market, if you look at the demand for Australian assets, the most important contributor to the boom of the mining industry in Australia in the last 30 years has been China. And we have 3 more Chinas on the runway. Well, you know, they have you by the nose and you have them by the nose. And you know, hopefully nobody twists. Hopefully we learn that you have something they need and they have something called money that you need. And, you know, we trade it all peacefully and everything works out well. But it's important to note that, you know, India limps along, gets a little better every year. There's 1.3 billion of them. Wall Street is pretty good at dealing with changes in interest rates. What they're not good at dealing with is changes in credit quality. Because they don't get paid not to earn fees. And their lending standards in bull markets deteriorate. The other thing that really scares me personally about Wall Street, at least the banking sector on Wall Street, is the increasing complexity and size of the derivatives market.
Exactly.
The big banks, JP Morgan Chase, will tell you that although they have 50 or $60 trillion of nominal derivatives exposure, that their real exposure is much less because they're offset longs against shorts. What they forget to tell you is that that assumes that the counterparties pay. If you have a $50 trillion notional liability against a $400 billion balance sheet, what you're suggesting is that you are smart enough to operate a big bank with a 0.4% equity slice. I believe that Jamie Dimon is substantially smarter than I am. I believe that the correct equity slice for my bank is 10%. He believes that the correct equity slice for his bank before derivatives exposure is 7%, and after derivatives exposure is 35 basis points, 1/3 of 1%.
Wow. Yeah,
Now
that's
that works until it doesn't. And history has shown that that's likely correct. Treasury, unfortunately, will not bail Rick Rule out. Um, but if you ask me what scares me, the decline in lending standards, the financialization of junk debt, which we'll go into in just a second, and derivatives. And we should talk about the financialization of junk debt. Junk debt is perhaps an American term for privately or publicly traded debt
mhm.
from non-investment grade issuers.
Yeah.
And there's been a huge global, but sadly, particularly US industry in junk debt. And what's happened, because it has very high yield in an environment where most investors are looking for yield. Investors who don't understand the risk associated with that yield have been piling into junk debt. And a lot of junk debt in the US market and also the British market is in exchange traded funds. These
Ah,
exchange traded funds are hugely liquid, but the assets they hold aren't liquid.
mm,
And if we have a circumstance where ordinary investors get concerned about credit quality and they sell the shares of the ETF, and the ETF is forced to sell their underlying assets to redeem the ETF shares, they're trying to sell assets into a market that's ill prepared to equip them. When I was a young man in the last junk debt crisis we had in the US in 1982, we had a saying for illiquid junk bonds that you went to sell that were illiquid. You call your broker and say, sell my junk bond. He says, oh, that's an owl bond. An owl bond is when you call your broker to sell it and he goes, to who? And that scares me. I mean, it really does scare me. I look at, as you know, I'm a credit guy by background, and I look at the covenants around these bonds, and the covenants were put in place by Wall Street to benefit the issuer, not the investor.
mm.
That's all good until things go wrong.